Before we jump into today's deep dive, let's give you something special. At Insightful Value, we uncover stocks the market is sleeping on. We bring you in-depth analysis of undervalued companies without the jargon, and Erie Indemnity might just be one of them. This video is for informational and educational purposes only. This is not financial advice. So make sure you hit that like button, subscribe to the channel, and let's explore whether Erie Indemnity is quietly setting up for a bounce or warning us to stay away. Now, Erie Indemnity Company isn't the type of stock that screams for attention. It's not flashy. It's not on trending investor lists. But behind the quiet name is a company that's been around for nearly a century. Founded in 1925 and operating out of Pennsylvania, Erie Indemnity acts as the management company for the Erie Insurance Exchange. Basically, it handles underwriting, sales, policy issuance, and customer service on behalf of the exchange. So it's a behind-the-scenes operator in the insurance space, earning fees rather than taking on insurance risk directly. So why are we talking about it now? Because the stock is trading low relative to its recent history. Over the past few months, shares have slipped, raising the question, has the market missed something here? Or is this the start of deeper issues? Financially, Erie Indemnity has historically been a solid performer. It generates predictable fee income, has low capital intensity, and boasts operating margins in the 20 to 25% range, which is strong for the insurance service segment. The company reported steady revenue growth over the last 5 years, driven by policy growth across its network. Its latest earnings showed moderate top-line expansion, although cost pressures, especially labor and tech investments, have started squeezing margins. Dividends? Erie Indemnity has been paying and growing its dividend consistently for years. The current yield sits just below 2%, not spectacular, but backed by a history of stable increases and a conservative payout ratio. For dividend-focused investors, this kind of reliability is worth noting. But here's the risk side. The company's revenue is tightly tied to the performance of the Erie Insurance Exchange. So if underwriting activity slows down, or if regulatory shifts hit the industry, Erie Indemnity's fee income could take a hit. Another concern is tech disruption. Like many legacy players, Erie's long-term competitiveness depends on how well it adapts to digitization and consumer expectations in a tech-driven market. On the valuation side, the stock recently pulled back from all-time highs, and it's trading at a more reasonable price-to-earnings multiple compared to its own historical averages. Not exactly cheap, but certainly more interesting than a few months ago. For long-term investors seeking stable cash flows, low debt, and a niche moat in insurance operations, this might be worth a second look. But for momentum chasers or those looking for rapid growth, it might feel too slow. So why invest now? The stock is down, the fundamentals are still relatively intact, and the company is financially conservative. That could mean the market is just overreacting. Why not invest now? Growth is modest, risks are real, and there may be better opportunities elsewhere if you're looking for higher returns. If you're into clean business models, recurring revenues, and dividend reliability, Erie Indemnity has qualities you might appreciate. But as always, do your own research and make sure it fits your strategy. For more deep dives like this, where we break down undervalued companies in plain English, check out insightfulvalue.com. We're all about simplifying complex finance so you can make smarter investment calls. Don't forget to like the video, subscribe to our channel, and visit insightfulvalue.com for more insights just like this.